Good morning, accounting students. This is the last video under the financial management section. This is not so much for examination, might be, for example, discussion question in test 3 or something along those lines. It's where we take everything we've learned and we kind of reverse it. And this is what we would spend a lot of time on in, for example, in investment management, where we're trying to set ourselves, well, we understand how accounting works now. We understand how we're trying to manage the company. How does this help us? Well, ultimately, as an investor, what we're most concerned with is the valuation of our share. Now, in the current climate of COVID-19 and shutdown of economic systems, a lot of this might not seem to hold true, but a lot of that has got to do with fear and uncertainty. And we know that with fear and uncertainty increases risk, risk increases the discount rate. So even though companies look possibly having great futures, those discount rates have increased sharply, which has meant that the discounted present value of those shares has dropped significantly. Not only that, but obviously there's a lot of uncertainty regarding those future cash flows themselves. So people have kind of rolled back a little bit on their estimates of what they think they're going to be worth. What I want to do is just give you an overview of the different parts that we would consider. When valuing a company, ultimately we're interested in valuing the equity. And so we want to value the equity as a whole, figure out how many shares there are, and take that equity divided by the number of shares. We may, however, need to value the debt separately. And so we know that if your bonds are paying interest at a rate that is different from the current market rate, they'll either be worth more or less, which is either good or bad for you. If they're worth more, it means that the chances are you're paying a higher interest rate than the market rate, which is not good, which would happen now because interest rates have dropped. But obviously the converse can apply as well. And so we need to use the principles of time value money to value those bonds. It is possible you could have preference shares, which are more like a perpetuity. They don't have a redemption date, so we just have the formula for a perpetuity there to value those. However, for most of the time, we're focusing specifically on the company and the equity. And we'd have to decide, are we looking at like a reasonable amount of shares that we're purchasing, or is it just a couple of shares? If it's just a couple of shares, we'll have to take our minority perspective. In other words, that stockholder doesn't have any influence over the company. You can't buy a share in Walmart and then go into the next annual general meeting and tell them what to do. It just doesn't work that way because you've got one share out of hundreds of millions. And so you have really no say. So the only thing that you have that is actually worth anything from a valuation point of view is the dividends you get, if you get any. And so the only thing you can value are those dividends. If the dividends are relatively constant, obviously we can value them as the dividend amount divided by I. They probably, however, are growing. So more likely it's meant to going to be dividend over I minus G. Okay, however, what could also happen is they could be in a situation where your company is doing very well, they're growing rapidly, but that's not likely to be sustained for a long time period. So what's going to happen is you've got dividends growing very rapidly, but then at some point they're going to reach a peak and then flatten out. How would we value that? Well, you want to go and value these rapidly growing dividends separately, and then once they reach the constant kind of growth rate, you would use that formula. And you'd have to combine those two together, and you'll be doing that in investment management and probably financial management as well. Okay. If we're assuming that we are looking maybe at a majority stake in this company, then we have to ask ourselves a couple of questions. The first one is always, is this company a going concern? In other words, is it likely to continue operating in the future? If it's not, the earnings and cash flows are irrelevant, because typically what we're thinking about is we're saying, oh, we're looking at these future cash flows and we want to know what they are worth today, and we're trying to discount them back. Well, if we're not certain about those cash flows, that method wouldn't apply. And all we've got are those assets that are there today and what we could sell them for, and then we'd have to settle out any liabilities. So that's known as liquidation or net asset value approach. We'll value what we can get for the assets, we'll subtract the liabilities, and that will give us the value of this equity. Okay. Before we get to the primary methods, however, I wanted to talk just a little bit about some simplistic methods that some people use. I'm not a big fan of these, but they are very quick and they give you some very quick answers. And they're kind of like reverse engineering things. And you can use it for earnings yields and PE ratios. I want to focus on the PE ratio. So we know that the PE ratio is the market price of the earnings per share. So if you wanted an idea of what the market price might be, it would be the, reverse that out, PE times by the earnings per share. You might think, well, that's just going to take us in a circle. Yes, it would. Unless you're looking at what we call the forward PE ratio, not what current market calculations give you, but what you think that company is worth. And you might go on some financial websites like Yahoo Finance, and they might give you those forward PE ratios. It's what you think the company is worth in terms of like, how many years would I wait to get my earnings back from this? And then you can multiply it by your projected earnings per share, and it would give you a valuation. And you can use the same approach with earnings yield. Those are quick ones, they're not detailed. Most analysts, however, are going to go into a lot more trouble of actually projecting those future cash flows and discounting them back. And then there's just two questions that we have to ask under that approach. Are we looking at the earnings just by themselves? If we are, we're going to get a valuation of the assets. What discount rate would you use? If you're just looking at those operating cash flows, well, when you're trying to work out the present value, you're going to use weighted average cost of capital. Why? Because those earnings belong to both the sets of funders. Okay, so you use a weighted average cost of capital, and it's total operating cash flows, which includes cash flows associated with just the assets, nothing to do with the liabilities and funding source. There is an alternative approach where you look at it just from the perspective of the owner's equity, and they talk about free cash flow to equity, free cash flow to equity, something along those lines. Sometimes they just call it free cash flow and they put two F's there. I don't know why. But here what we're looking at is the cash flows that belong to the owners. So it's the cash flows from the assets, less any cash flows associated with the loans. And what's important here is the I that we use. Because you've built in the cash flows from the liabilities, we're not interested in weighted average cost of capital. We're interested in just things that belong to the owners, so we're going to use RE, the required rate of return for equity. So it's the cash flows. If you think of the cash flow statement, it's the operating cash flows less any financing cash flows associated with loans. Whatever's left over, that is what we're going to be looking at, and we're going to discount them at RE. Remember, when you get a value there, you'll get a value of equity divided by the number of shares to get a value per share. When we get a value over here, it's a value of the assets. We still have to go and subtract the valuation of liabilities to get the value of equity. And you'll be doing more of this in your subsequent classes, probably investment management and maybe managerial finance as well. Thank you very much. And that's the last of our videos for the year.